Hello everyone, I'm CA Dinesh Reddy, and today we are starting a special two-part series on the GST updates you need for the financial year 2026-27. In this first part, we are diving deep into everything you need to know about the GST Composition Scheme, the critical March deadline, the massive tax benefits, who exactly qualifies, and the important steps for those switching from the regular scheme. Whether you're an MSME owner or a tax professional, this information is vital for your planning. Let's get started with the most important date on your calendar. Let's start with the GST Composition Scheme. If your business is looking to opt into this scheme for the financial year 2026-27, there is one date you absolutely cannot afford to miss: March 31st, 2026. To opt in, you must file Form CMP02 on the GST portal before March 31st. Once you do this, your enrollment under the composition scheme becomes effective from April 1, 2026, the very start of the new financial year. The great news is that the opt-in facility is already live on the GST portal right now, so there is absolutely no reason to wait. Now, you might be wondering, why should I even bother with the composition scheme? What is in it for me? Let me walk you through the benefits in detail. The composition scheme is fundamentally designed to simplify GST compliance for smaller businesses. Instead of maintaining detailed invoice-by-invoice records, calculating input tax credits, and filing complex monthly returns, you pay a flat, lower rate of tax on your turnover. It's simple, it's predictable, and for the right type of business, it is extremely beneficial. Let's talk numbers. Here are the tax rates under the composition scheme. Traders and manufacturers pay just 1% on turnover. Restaurants not serving alcohol pay 5%, and service providers pay 6% on turnover. Opting for this can reduce your effective tax burden by 30 to 50%. Additionally, your compliance burden drops dramatically. No more complex GSTR1 and GSTR3B monthly filings. The composition scheme replaces all of that with simple quarterly and annual filings. Now, before you rush to the GST portal to file CMP02, let's make sure you actually qualify. For most states, your annual aggregate turnover must be less than Rs 1.5 crore. For special category states, the limit is Rs 75 lakh, and for service providers, it's Rs 50 lakh. There are also key restrictions. You cannot opt for the composition scheme if you make interstate supplies, supply goods through e-commerce operators, or manufacture notified goods like ice cream or tobacco. Please review these restrictions carefully before filing your CMP02. Filing incorrectly can lead to serious compliance issues down the line. Once you're enrolled, your filing workload drops significantly. Form CMP08, your tax payment statement, is filed quarterly by the 18th of the following month. Your annual return, GSTR4, is due by June 30th. Compare this to the 24 returns per year under the regular scheme. This saves both time and professional fees. But remember, missing that March 31st deadline means you're stuck in the regular scheme for the entire financial year. Here's a critical step. If you're switching from regular to composition, you must file Form ITC03 by May 30, 2026. This is to reverse the input tax credit you've already claimed on your existing stock. Since you can't claim ITC under the composition scheme, the law requires you to pay it back for the goods you still hold. Failing to file ITC03 can lead to disputes and heavy penalties. Be proactive and calculate your reversal accurately. That covers the essentials of the GST composition scheme for FY 2026-27. Make sure to check your eligibility and meet those deadlines. In our next video, part 2, we'll dive into the QRMP scheme and the specific compliance risks you need to watch out for. Don't forget to like this video. We'll meet in part 2. Until then, stay compliant and stay ahead. Thank you.